Hi guys, hope you guys still doing well. Today I just got you something different. Without wasting any time, let me just get to it. So this is a proper setup for buy and sell when you want to have long entries. I'm talking about the swing traders right here because our model is a scalping model. But if you want to be a swing trader and you want to use the central bank dealing range, it's very simple for you to trade this model. More details are on our mentorship, so I cannot explain more of the things I'm going to be doing here, but I just want to make you understand and have an idea on what setup we're going to be doing regarding this swing trading entry. So we have a few steps here that we need to follow. Step one, mark the 18-hour candle using the vertical line. Also mark the 00 using the vertical line, the midnight candle. So I'm just going to take this line here and mark the 18 hours, which is here, and also mark the 00-hour GMT, which is here. So we already marked the 18 hours and the 00 hours. We explain more into detail in the mentorship. As I said, I cannot get into detail on why exactly we're marking these specific hours, but we explain more in our mentorship. So step number 2, use a rectangle, measure the 18 hours to 00 hours highs and lowest low, highest high and lowest low. So this is the box. I already fixed the box here to make the lesson to be easier. So this is the lowest low. Let me put it properly. Yes, this is the lowest low between 18 hours and 00 hours. This one here is the lowest low. This is the highest high. So you just take your regular box, your regular rectangular box right here, this one. You just mark from this high to this low. So this is the low that I'm specifying on here. Then step number 3, divide the range to 2 and use the rectangle to measure from premium to equilibrium. So we divide the range into 2. So we have the premium here at the top, and the equilibrium obviously is the half of the box, and this is a discount at the bottom, and the equilibrium which is half the box. So here we just take another, oh sorry, let me just take this box because I already measured it. We just take this box here. As you can see, this is the half. This is the half of the range. This high here and the equilibrium, the premium and the equilibrium. Then you take this half and you extend it in time. That's the next step. Right here. So here is it here. Oh no, this is the wrong number. Let me get the right box for this. I think this is it. No, this is 4. This is 2. Here is 1. Yeah. So here it is here. Same range here. Then step number 4, use the half deviation box to multiply it by 4 and extend in time above if bullish or below if we're bearish. So as you can see, the market is bullish. We're having higher highs and lower lows. Our highs is going up. So now that we know that we're targeting this, we have this daily fair value gap here. We know that our market is bullish. So we're gonna take the half of this box and measure from box 1. Here's 1 here. 1. Same size. 2, same size. 3, same size. 4. So these are our 4 deviations. These deviations is where price is likely to go to on a daily basis, because this model can happen like every day in a week depending on how good is the week, so it requires a lot for you to understand if the week is moving on a right bias or an opposite bias or is consolidating. So at this point we are bullish, and this was on Thursday, the 2nd of January 2025, as you can see here on my cursor. So now that we've put the box in time and we're bullish, we mark the boxes up, we confirm the deviation with the fib. So we have our Fibonacci right here. We confirm if these lines, these blocks are on a good deviation. So we see from the equilibrium to premium. There you go. You see, this is the first deviation here, which is here. Second deviation, which is here. Third deviation, which is here. Fourth deviation, which is here. This is the daily bias of the day. You can literally just trade from having this model here, measuring this low to this high, find the equilibrium. After finding the equilibrium for this low, you take the upper half and you multiply it by 4 above until it gets to the fourth deviation. Then to confirm that if these measurements are correct, you just take the Fibonacci and use this equilibrium to premium, which the Fibonacci, we have our own settings that we have on our mentorship, so I cannot display them right now, but we have them in our mentorship. You can just click the link in our description, and it's gonna send you through our WhatsApp channel, and you're gonna be able to communicate more when you get there. So if you can see here, from this low here to this high here, we have the 50% here, which is the green line, this 0.5%, which is the green line, and we have a fair value gap below it. So at this time, we have our model called the 711 model. You can check out our previous videos. We have multiple videos that which we did this model. You can be able to check them out and see how we trade the model. So as you can see, this is 1 a.m. candle here. This can be your initial entry if you can understand the model that you're trading. So if you can see this 50% here, below it there's this fair value gap. So we buy on a discount and sell on a premium. So this is going to be a discount area where we buy, and we are going to target the fourth standard deviation. That means you can hold the trade from here up to here for the whole day, or for until it gets to the fourth standard deviation. So this is the central bank dealing range model, where we can just swing trade from the morning up until the closing of the day. You can have the initial of the whole day model, the whole day range. You can grab it by using only this model here. So this is the buy side of it, and I'm going to show you also the sell side of it using the same rules. So we're going to go back to the rules. Rule number 1, mark the 18 hours candles and 00 hours candles. So now we're marking there for the sell side. For the sell side distribution, we're going to be marking the 18 hours also. Same rules apply, same everything. Then we have the 00 hours, which is here. Here is the 00 hours. Then remember, number 2, using the rectangle, we'll measure the 18 hours highest high and lowest low, which is this one. Here's the 18 hours highest high and the lowest low. 18 hours lowest low and highest high. Then use the half deviation box to multiply and multiply it by 4 and extend it in time above if we bullish or below if we bearish. So at this point, this side we're bullish, so we multiply it higher. So now we got to the daily fair value gap. That means we're gonna expect a reversal from the market. So now we're gonna be looking for the deviation low. Still same apply. We're gonna need the four boxes that can, yeah, this is the first box. As you can see, this measurement is the same as the from discount to equilibrium. This is the box that we use, the 50%. That's what we use. So we take this. This is the first deviation. This is the second deviation. This is the second deviation. This is the third deviation. Yeah, this is the fourth deviation. So ICT normally calls this the fill in the 4. I actually get this model from ICT, and it's been working for me. This is the only model you can trade using when you're trading forex. It's very perfect for forex. As you can see, now we're confirming if the deviation are correct. So here we are. First deviation, here it is. Second deviation, here it is. Fourth deviation, here it is. Here are all the deviations, and you see this here. This is the midnight candle. That means this is the end of the day. We've filled the fourth deviation, counting from deviation 1 to deviation 4, using the discount of the dealing range. The Asia, this is basically the Asia range. We're using the discount of it, and we find the fourth deviation. Same applies, same rule applies here. This range here, this the discount range, there's a 50% here, which is this one. Look what we have here. We have a fair value gap here, and the price traded above the fair value gap. You see here, traded above fair value gap, and also we have our model, the 7 a.m. model. This, as I said on my previous encounter on this one, you can check our video where we trade the 7-11 model using 7 a.m. candle and using the 1 a.m. candle. So this model can just give you the bias for the whole day if you can be able to backtest it over and over and over. This model repeats every day of our trading day. So it's good when this model works most or when you trade forex, your euro, USD, GBP, not only gold. I'm just using the gold because it's like one of the major pairs that we like to trade. But you can basically trade any forex pair. You can find this model. You can find a specific entry, and you can trade like for the whole day without using any indicators, without using anything else. But by understanding the 7-Eleven model and by trading this model here, having this concept here that I'm using right here and following these rules here, is very easy. You see, even the entry on the time-based model, this entry is on my time-based model, the model that I use. Also, same time even here. So if you want to have more of these, more of the model, more of the examples, and more of the explanations on how to trade this model, you can just click the link in our description, and it's gonna send you through our WhatsApp. Then we're gonna be able to communicate more on how we're gonna work on helping you to get this model. So yeah, I hope it makes sense, and I hope it's gonna be easy for you to trade this swing trading model. Yeah, then good luck and happy trading. Thanks, guys. Thank you that you made it this far. Then yeah, see you in our next video. Cheers.